Assalamu alaikum warahmatullah. This is Abdul Salam, Assistant Professor, Department of Business Administration, Asian University of Bangladesh. Today's topics name is Basics of Cost Volume Profit Relationship. This is the course material for MBA 6463 Managerial Accounting. After completing this lesson, you are expected to be able to know the meaning of the objectives and assumption of the cost volume profit analysis, know the importance of the cost volume profit analysis, know the what contribution margin is to be, how it is calculated, and then solve the problem relating to the cost of volume, cost volume profit. First of all, we want to know that what is the CVP analysis. CVP analysis is an analytical technique used which examines the cost and revenue behavior behavioral pattern and their relationship with profit. So, cost volume profit analysis is the most fundamental tools because it is provide the straightforward ways to study the effect of the change in cost and the volume of the company profit. CVP analysis is important in the profit planning. In CVP analysis, executives and accounts recognize that there are many interacting variables that affect an organization's profit, such things as the sales of price of the product, the variable cost per unit, and the volume of production, and the variables cost, sales volume. CV analysis reveals the relationship among the interacting variables and the effect the change in the variables those have on the organizational profits. So CBP is the most important tools and techniques for decision making of an executives and account and higher authority of an organization. So for some sort of basic assumptions or components for CBP analysis. So the technique of CPP analysis reset on a set of assumptions. Their assumptions may be identified as the fundamental base of such analysis. The importance of the identifying the criticizing and the underlying the assumptions of CPP analysis rates on the practical applications of the CPP analysis. The assumptions underlying CPP analysis are mentioned below. Number one, total costs are separated into the fixed and the variable costs. Number two, a firm's total revenue changes in direct proportion to change in its unit sales volume, that is, average sales price per unit production in constant. Fixed costs remain fixed over the relevant range of activity. Number four, variable cost per unit is also constant, therefore the total variable costs are directly proportional to the volume. So here also some another assumptions like as selling price must be constant, price of the factors producing material price, wages rates are also be constant, there will be no changes in the firm's efficiency of the productivity. So from the assumptions we are very clear that if we analyze the CVP, then some sort of assumptions are strictly followed by the range of period. So without these assumptions, we don't get the good result from the CVP analysis, because CVP analysis is the tools and techniques for decision making, for how much product we produce, how much we sell, what amount of the product we produce in the future, and what is the profit we generate for the organizations. So it is the most important fact of must be following the assumptions and tools and techniques for the organizations. Then, objectives of the CVP analysis. From the definition and assumption, we are clear that there are some sort of basic objectives in here. Number one, make reasonably accurate forecast and future profit. We obviously, if we want to know the know when we are operating a business, then we want to know how much profit we earn after some specific period, how much wealth we are gather for the organizations, and how much we are invest in the future. So obviously it is important tools and techniques for the business executives as well as a owner of the organizations. And also it is necessary for them prepare the budget for the future activities. Then if we are analyzes the CVP, cost volume profit analysis, then we must be calculate the contribution margin. Without contribution margin, we did not calculate the or we did not analyze the CVP. So what do you mean by the contribution margin? Contribution margin basically it is the one kind of the profit which is over the variable cost to sales revenue. So one of the key relationships in the CV analysis is the contribution margin or same. Contribution margin is excess. Contribution margin is the excess of the revenue over the variable cost of generating that revenue. So এখানে খুব সহজে আমরা বলতে পারি যে হচ্ছে কন্ট্রিবিউশন মার্জিন হচ্ছে যে কি আমার টোটাল যে সেলস রেভিনিউ আছে সেই সেলস রেভিনিউ থেকে ভেরিয়েবল কস্ট বাদ দেওয়ার পরে যে অতিরিক্ত যে প্রফিটটা আমার কাছে থাকছে বা রেভিনিউটা আমার কাছে থাকছে সেটার নাম হচ্ছে কি কন্ট্রিবিউশন মার্জিন। সো we are clear that this is the simple equation for calculating the contribution margin. Now, the rules of the calculation of the contribution margin is equal sales minus variable cost of sales. Then here given a example. Using unit selling price taka 50, unit variable cost is taka 30, total monthly fixed cost taka 50, and unit sold taka 1000 units. So therefore contribution margin is sales minus variable cost of sales. Here 1000 units we are sold and taka 50% in price, so total sales revenue is 50,000 and 1000 units into variable cost is taka 30, that means is equal 30,000. So contribution margin is taka 20,000. Then we need to be calculate the contribution margin per unit. Selling price per unit minus variable cost per unit. From the following information, we are calculate the variable cost contribution margin per unit is equal taka 50 is the selling price minus variable cost is taka 30. So the contribution margin per unit is taka 20. Here we need to be a contribution margin per unit or contribution margin per unit ratios. It is very simple. Is total contribution margin divided by unit sold. Total, how to calculate the contribution margin per unit? It is the another rules is total contribution margin divided by unit sold, and then we get the contribution margin per unit. Then if we are analyzing the CVP, then we must be need to be a contribution margin ratio. And how to calculate the contribution margin ratio? The rules of the contribution margin ratios is the total contribution margin divided by total sales in taka into 100. So total here we get the total contribution margin is taka 20,000 and divided by number of units is total sales in taka is 50,000. So total contribution margin is 20,000 divided by taka sales taka 50,000 is equal into 100 is equal the contribution margin ratios. Also we are calculating the contribution margin ratios by the following ways: taka 20,000 into 100 divided by units sold, 1000 units sold into taka 50, so taka 50,000. So we get the easily result of the contribution margin ratio is 40%. Here we see that how to calculate the contribution margin ratio CMPU, that means contribution margin, that means contribution margin per unit divided by sales price per unit. This is the contribution margin per unit, contribution margin ratios per unit. So this is the way of calculating the contribution margin ratio. Also we are followed these types of the rules and regulations for calculate the contribution margin ratios. We know that ratios means portion of 100%. So 100% minus variable cost percentage. So we are easily calculate the contribution margin ratios, and here we also portion of 1 is minus variable cost percentage. Here variable cost percentage is 30%, 30 taka per unit. So here we are calculate the variable cost percentage in the sales ratios. So we are calculate easily contribution margin ratios. Here given that Example, the following information relates to the 3 months activities of a company which is manufactured in a single product. Month January, June 2004, July and August production 12,500 units, and then July 14,000 units, and August 16,400 units, and total cost is like 1,50,000, 1,24,000, and 1,38,400. Examine the above figures and calculate the variable cost per unit and total fixed cost. If we want to calculate the variable cost and fixed cost, then obviously we follow a chart. Here the month June, July, and August, 3 months. Units of production 12,500. Units of production July is 14,000. Monthly changes in the unit. This is not given our question. We are calculating the changes in units from uh, here. In July, we are produced 14,000 units, and June 12,500. So the differences is the monthly changes in the units. Then total cost in June total in our total cost is like 1,15,000, and July 1,24,000. So here increase the cost from June to July. How much amount? The amount is 9,000. So total cost increase in 9,000 and total production increase in 150,000, 1,500. So we are divided by 100, 1,500 to 9,000. Then we got the taka 6 per unit. So this is the variable cost per unit. So total variable, how to calculate the total variable cost. And number 2, calculation the fixed cost. Fixed cost, we know that the total cost is equal. We know that total cost is equal fixed cost plus variable cost. So we are use the mathematical expression. Then we got the fixed cost is equal to total cost minus variable cost. Here total cost is 1,50,000 and variable cost is 75,000. So 1,50,000 divided by 1,50,000 minus 75,000 is equal 40,000. If we calculate the July, then 1,24,000 minus 40,000 units into 600, so is equal to 40,000. If we calculate the fixed cost for the month of August, then we get the 1,38,000 is given that the total cost, and the production of units is 16,400 units, and into taka 6, and then we got the taka 40,000. Because we know that a fixed cost is always fixed in total, but variable cost is fixed in per unit. So that's why June, July, and August our fixed cost is same. So thank you so much for today's class.